Welcome to Facts Pro, where it's all about facts, financial, accounting, and tax strategies. All right, so today we want to talk about what should we expect this tax season. Now January is gone. You received your 1099s, your W-2s, and you're still waiting on some probably, but you've got some forms and you want to know what should you expect. If you start collecting and sending your information to your tax accountant, what you should be expecting this year that was different from last year, because this year is very exciting, is very different in a lot of ways from 2024 and prior, because of the changes that enacted into law on July 4th, 2025. That was some of it was retroactively was effective retroactively to January 1st, 2025. um, Again, with all the different due dates and effective dates of these provisions that were included in this law. So what you should be expecting, that's what we'll be talking about today. And I'm gonna share my screen and we'll start digging. And as you know, I always like to start with a joke, and the joke is related to the tax season, trying to stay organized during tax season, feeling like this. All right. So, what should we expect? What's new after the new law while we're filing for 2025 tax year? First of all, we said that it was signed into law July 4th, retroactive to January 1st. There are major changes impacting 2025 returns that we filed this year now. Because there were some extended the Tax Cuts and Jobs Act provisions that were set to expire end of 2025, but this law came and made it permanent. So we wouldn't see change here as far as like something has changed from what we used to. So we're not going to see that. But there are some temporary deductions that were in effect now through 2028, some changes into what can we take as a deduction. So first thing we see that there is an increased standard deduction. So for tax year 2025, if you're a single filer, you have up to 15,750 that you get to deduct from your gross income to that you won't be taxable, that you won't be taxed on. So 15,750 if you're a single, married filing jointly 31,500, head of household 23,625. Married filing separately is the same as single, which is a higher number from prior year. Okay, so first thing is increase the standard deduction. There is a new senior deduction, and this it was effective January 1st, 2025, till the end of 2028. You get an additional 6K deduction if you're if you're 65 or above. So, and if you're married couple, you're both above 65, you get 12K. So this is an above the line deduction, meaning that in addition to the standard deduction, you get this bonus deduction that you can deduct from your income to reach your taxable income. But there is some income limit here. So if you have, and that's why planning is really important, because if you're taking some distribution from your other retirement plans, you may consider that, because if you're single, having other source of income, and your modified adjusted gross income is over 75K, this bonus deduction or senior deduction starts to phase out, and it's 150K for a joint return. All right, so those are for the seniors. Sole deduction, the state and local tax deduction, we know that it was capped at 10K, and for people who live in a high state tax like us in New York, New Jersey, California, all these states have a lot, they pay a lot of state taxes. So we were very pissed at this, and it was capped at 10K back in 2018. Now it goes up to 40K for 2025 till 2029. So, and not only that it went up, it starts to get in, like there is an inflation adjustment starting 2026, like a 1% after that. Okay, but also it has something here that you have to bear in consideration and consider when you do some planning, because it phases out for high earners, begins at a modified adjusted gross income of 505K. But it gives you very big benefit in your planning when you do your taxes. You need to just consider it. And this includes whatever taxes you pay to the state on your income tax, whatever taxes you pay to the property tax, and any of that. All right. Okay. No tax on tips. No tax on tips here. There is above the line deduction up to 25K annually for qualified tips and eligible occupations, and it phases out with a modified adjusted gross income over 150K single, 300K joint. Tips is still subject to payroll taxes. Okay, so this is an above the line deduction up to 25K annually, and it's only for the qualified tips. So they have a list of who would be who would be considered that it's tips. You cannot just consider any income that it's tips. It has to be like if there is a list of who would be considered be having tips as qualified. And it has this income limitation as well. All right, no tax on overtime, and we're not talking about whatever you get paid in overtime. It gets deducted. You don't pay taxes only on the premium portion of your overtime, which is the extra 50%. So this has to be with the like the Fair Labor Standard Act. So usually, if you're working more than 40 hours, you get paid 1.5 times. So this 0.5 times, the extra 50% is what you can deduct from your premium. But it has a cap up to 12,500 single, 2,500, 25K for merit filing jointly. And it phases out if your modified adjusted gross income is over 150K single, 300K joint return. Okay, so this is a major difference in 2025 that brings a lot of people more refund as we go. And you may need to look at this number in box 14 because your W-2 wasn't yet ready to reflect this change. So starting 2026, this will all be reported correctly, but 2025 it's not required because the law was like just in a rush and it was just made in the middle of the year. There was no enough time to update the forms. So just employers, if you're a business owner, you sending W-2 to your employees, you need to include that. You're encouraged to provide that in box 14, or otherwise, if you're an individual, you need to look at your last pay stub, give that to your tax accountant to properly calculate it. 100% bonus depreciation is restored. So there is a permanent 100% bonus for property acquired after January 19, 2025. So prior to that, you go to the 40% rate that was in effect, but January 19 is when you get 100%. And it applies to the qualified assets with 20-year class life or less. You immediately expense your equipment, your computer, your vehicle 100% on it if you acquired it after this date. R&D expense deduction, you get an immediate deduction which is restored for the domestic R&D, and this goes in effect 2025. So there is no more 5-year amortization requirement. And any capitalized amount that you had to do before, you can accelerate it, or you can go back and amend, and you can go back to years 2022 up to 2020, like to 2024, and you can amend it if you want, or you can choose to accelerate it and get it expensed in 2025. But starting 2025, you just get to deduct it immediately. Business interest deduction. This is also the calculation goes back, the adjusted taxable income calculation goes back to the EBITDA versus base away from the EBIT, earnings before interest and taxes. Now you can add back the depreciation and amortization. So that allows you to deduct more interest expense is not as limited as it used to. So there is a major benefit for capital intensive company because of that. QBI deduction made permanent, so you're not going to see change there. Everything stays the same. Child tax credit, the refundable portion made permanent. Also, no changes there, except that it be indexed for inflation after 2025, and it phases out if your modified adjusted gross income is over 200K single, 400K joint. There is a $500 credit for other dependents, also indexed, meaning that it would go up with inflation after 2025. Okay. Estate and gift tax exemption, stays the same. It increased for 2026 and indexed annually, so nothing to be done there. Key 2026 filing deadlines. The tax season already opened. The IRS accepting tax returns starting January 26th. The individual returns is due April 15. Partnership returns, S Corp returns March 17. C Corp is April 15. Non-for-profits May 15. Client action items. So you need to review your eligibility for tips and overtime deduction. You need to review that with your accountant, verify your senior deduction qualification. When you're reviewing your tax return, you may need to look at these things. Evaluate your SALT cap increase benefit, assess capital expenditure timing for bonus depreciation. Also consider your R&D expense acceleration strategy, review business interest deduction calculation, update your payroll system for 2026 W-2 reporting, and evaluate amended return opportunities. You may need to go back to amend returns, especially if you have an R&D. All right, so few strategic planning opportunities there. You need to maximize your temporary deduction before 2028 sunset, because we never know if this is gonna expand or just sunset in 2028, but we have it now. Accelerate capital investment for 100% bonus. This is stay with us for a couple of years. Roth conversions for seniors now because there is a new deduction. Business structure optimization for QBI. So there is always, with the new changes in the law, there is always a chance and opportunity for planning. So you just need to stay proactive and not wait till it's too late to do anything about it, or till the year ends and the law is no more in effect and all that. So timing is a huge factor in regards to planning. So if you have any questions, I would happy to discuss how the O3BA affects your specific situation. Get on my calendar and we'll have a conversation and see if we can help reduce your tax burden. All right, thank you and hope you found this helpful. And if any questions, let me know. Thank you.